YOLO. Have you ever wondered how banks make money? And I mean make money in a more literal sense. Not like how you and I make money. You and I make money by going to work, getting a paycheck, maybe investing, getting stocks, dividends. But banks, they make money in a more literal sense. Now, to understand this, we gotta take a look at where our money is actually made. The physical dollars are printed. At least for the time being anyway, before they move to all digital. So, every dollar that is made by the Department of Treasury. A small sub-branch of the Department of Treasury called the Bureau of Engraving and Printing is responsible for the actual physical construction of every single dollar we have. Whether it's a $1 bill, $5 bill, $100 bill, they are the ones who make it. But the ones who control when and how much they make is the Federal Reserve Bank. The Federal Reserve Bank is in charge of ordering new money creation, destroying old and damaged money, and then distributing the money to other banks, national banks, regional banks, city banks, whatever it may be, in a safe, secure manner. But the Federal Reserve Bank is not part of the federal government. It does not hold a reserve of cash, and it is not a bank. At least, not in the way that we think of banks, where we can go open up an account, deposit money, withdraw, etc. They don't operate quite like that. So then why is it that I say banks create their own money? They can't produce any physically. They can't make and mint their own dollars because that belongs to the Bureau of Engraving and Printing, controlled by the Treasury, which takes orders from the Federal Reserve Bank. So, how are they able to create their own money? Well, that's where you come in. You see, you work hard for your money, and you have to put it somewhere. You're not just going to stick it under your mattress. So let's say you deposit $1,000 into the bank. Now, typically what would happen is the bank would keep a fraction of that money in reserve in case anyone needed to make a withdrawal and have physical cash on hand. So let's say you drop $1,000 in, they keep 10%, which is $100 on hand just in case. They then take that other $900 and they loan it out to somebody, collecting interest payments from the loan. Now, your account still says $1,000, but they just took $900 and loaned it to someone else. So, really, your money's no longer there. That's how they create new money. By loaning out your money to other people, collecting a very high interest, and then paying you a small bit of interest for keeping your money there. Now, the system works because they have enough customers that if you decided you needed to withdraw your full $1,000, they would just dip into the reserve amount for each of the other customers, give it to you, so that there's no problems. However, if 1, 10, 20, 1,000, 5,000 people all at once withdraw how much money they have in their accounts, there could be a run on the bank. A run is when the bank doesn't have enough cash on hand to cover all the sudden withdrawals. This could be a major problem. Now, another problem is, what happens if the people who are borrowing don't pay the money back, or they default on their loans? Now, same thing with withdrawing. One person, not that big a deal. 10, 20,000, 10,000. You could have a major collapse if too many people fail to pay back their debts. This is what happened in 2008. They were giving out way too many home loans for unqualified borrowers. In some cases, people who were even unemployed and had no way to pay it back were getting qualified for home loans. They then didn't pay back their loans, surprise, surprise, and when the banks realized they didn't have the money coming in, people were trying to withdraw their money, no one was paying back their loans, and they were unable to sell off all these houses, everything started crumbling, and the government had to come and bail them out. Or what happened with a lot of them, the Federal Reserve loaned the banks money to cover the situation. But the banks had to pay back that loan with interest to the Federal Reserve, which is another way the Federal Reserve makes money. But most of our money now is made by debt. Whether it be debt they sell to other people with your money, or debt from bank to bank. Now, if you're thinking to yourself, that sounds economically unstable and dangerous, like the house of cards could fall down at any minute. That's because it is. Or more accurately, it was. After 2008, they learned a big lesson, which is don't go giving out home loans or large loans to people who have no way of paying it back, which really sounds like it should be common sense. But when there's an opportunity to make a quick buck and there's not a rule that forces you to avoid that opportunity, people will tend to try and take advantage. So new rules and regulations got put in place. Now, because of that, it reduces the chance of a major crash like that happening. But it doesn't eliminate it because the same underlying problem of fractional reserve banking exists. And really what it ended up doing is just making home ownership much harder for the average person. Because to avoid a situation like 2008, they increased all the requirements to get a home loan. The snapback effect happened. And now it is incredibly difficult to qualify for a loan that your grandparents or even your parents would have been able to. Now, something of slight concern is that during the 2020 pandemic, they removed the minimum required amount to keep in reserve. So theoretically now, if you deposit $1,000, the bank can loan the entire $1,000 out, potentially putting us at a higher risk level than we were in 2008. Now, from what I read, banks try to mitigate risk through their own internal risk management system, which sounds incredibly vague, and pretty much that they're just doing their own thing, and they know what they're doing. They've never been wrong before, right? But it's been 5 years, and we haven't collapsed, so maybe things aren't as bad as it seems on paper. In a nutshell, that's how fractional reserve banking works. That's how banks make their own money. That's a general idea of what the Federal Reserve Bank does, or what it's at least supposed to do. It does a lot more than that. Thank you for watching the video. Don't forget to like, comment, and subscribe. And as always, I'll catch you on the flip side.